The Monetary Policy Committee took note of an important change in the baseline inflation trajectory with respect to the June 2017 statement. This trajectory now incorporates the first round impact of the implementation of the House Rent Allowance award of the 7th CPC by the central government. Excluding the HRA impact, which will affect the CPI cumulatively, headline inflation would be a little above 4% by Q4, as against 4.5% inclusive of the HRA in the June statement. Another important development noted by the MPC is that inflation excluding food and fuel, which has hitherto been sticky, has fallen significantly over the past 3 months. These factors, along with the normal and well-distributed rainfall and the smooth rollout of the GST, opened up some space for monetary policy accommodation. Accordingly, the MPC decided by a vote of 4-2 to reduce the policy rate by 25 basis points. Recognizing, however, that inflation is expected to rise from the current lows over the rest of the year, the committee persevered with a neutral stance. With several factors contributing to uncertainty around the baseline inflation path, implementation of farm loan waivers, the after effects of the GST, the timing of implementation of salary and allowance revisions by the state governments, the MPC emphasized its commitment to keeping headline inflation close to 4% on a durable basis. While retaining the projection of real GVA growth for 2017-18 of 7.3%, same as the June 2017 forecast, the MPC noted that while the outlook for agriculture appears robust, underlying growth impulses in industry and services may be weakening slightly. Given corporate deleveraging and the retrenchment of investment demand. In this context, it was of the view that there is an urgent need to reinvigorate private investment, remove infrastructure bottlenecks, and provide a major thrust to the affordable housing program of the government. The government and the Reserve Bank are working in close coordination to resolve large stressed corporate borrowers and recapitalize public sector banks within the fiscal deficit target. Eventually, these efforts should help restart credit flows to productive sectors as demand revives. I'll now request Dr. Acharya to say a few words and then Mr. Vishwanathan.
Thank you, Governor. Good afternoon, everyone. As we mentioned in the past and as Governor has just underscored, addressing the twin balance sheet problem remains the Reserve Bank's top priority at the moment. Investment slowdown in our assessment is significantly rooted in the resulting debt overhang problem from this twin balance sheet issues. With the cleanup on banks' NPAs currently underway, we are striving to meet in near future an important prerequisite for effective transmission of monetary policy, namely robust health of balance sheets in the financial and the real sectors. In order to supplement these efforts, let me mention 3 developmental steps that the RBI will be undertaking to improve financial intermediation in the economy going forward. One, will be releasing in coming weeks the final guidelines for tri-party repo, which we hope will pave the way for a vibrant corporate bond borrowing and lending market, providing better liquidity and price discovery, reducing market cost of capital, and allowing access to non-bank finance for a greater number of borrowers in the economy. A thriving corporate bond market would in itself improve monetary policy transmission by creating a direct impact of interest rate changes on a bigger part of the real sector in the economy. Second, to improve transparency in credit markets and to facilitate better early intervention as well as risk-based counter-cyclical provisioning, the Reserve Bank has decided to put in place a high-level task force comprising experts and relevant stakeholders. This task force will evaluate the existing public and private infrastructure for credit information, assess any data gaps, study the best international practices, and provide a roadmap for the development of a comprehensive near real-time public credit registry for India. Let me stress that the objective is to improve not just the credit assessment by financial lenders, but also of the financial lenders themselves. Third, the experience with the marginal cost of funds-based lending rate or MCLR system introduced in April 16 for improving monetary transmission has not been entirely satisfactory, even though it has been an advance over the earlier base rate system. We have constituted an internal study group across several clusters to study the various aspects of this MCLR system and to explore whether linking of the bank lending rates could be made direct to market-determined benchmarks going forward. The group will submit the report by September 24th, 2017. One last point, the currency in circulation is showing early signs of normalization. There remains, however, much surplus liquidity in the system that the Reserve Bank has been managing. We remain in touch with the government to make our toolkit for this task more complete. In the meantime, we will continue with surplus liquidity management using instruments indicated in the April policy. Thank you.
Point which Dr. Acharya referred to on the credit registry. We have been taking progressively measures to improve the effectiveness of the credit information that is filed with the credit information companies. And these reforms started with requiring all the banks to report all the data to all the CIs so that there is no fragmentation. Subsequently, we wanted them to dovetail the SHG data into the credit information companies. And now we are making it mandatory for the CICs to issue what is such a comprehensive credit information report, because they used to carry the reports in various subsets in the form of what do you call industry, personnel, MFI, and things like that. And they used to only give information based on the particular area from where the demand is coming. Now we're seeing, irrespective of where the information is being sought by, the comprehensive report covering all the bureaus in which the information is kept should be provided to the credit information seekers, so that the quality of credit assessment is better. The second, of course, is again, Dr. Acharya referred to the improvements that we're looking at the MCLR and what to do going forward. But when we introduced the MCLR, we are also allowed the banks that were the existing borrowers are under the floating rate and the base rate system, they could move to the MCLR on mutually acceptable terms. But we find that the base rate is relatively more rigid. So we need to look at, because quite a few borrowers are still under the base rate system, so the monetary transmission is to that extent impacted. So we will look at how we need to how we can make the base rate a lot more responsive to changes in the cost of funds of banks, and that's something that we'll be exploring very shortly. And we'll have discussions with the banks on this issue going forward. On the NPA front, as we know, we have taken substantial action after the Banking Regulation Amendment Ordinance was passed. As indicated in the press release of June 13, 2017, we have, on the basis of recommendations of JC, Internal Advisory Committee, directed banks to refer 12 cases for resolution in the IBC. All these 12 cases were referred by the banks to the IBC and the IBC, and they are in the various stages in the NCLTs of the respective NCLTs, the respective benches. Of course, dealing with this test assess is an ongoing process, and we're working on the next steps.
Okay. Thank you very much. Take a few questions now. Hindu Business Line. Use the mic, please. Thank you.
On the one hand, there is a liquidity overhang in the system. Yeah. So, do you think there was a need at all for you to cut the rates? And then you also have a situation where inflation could rise down the line, actually.
Well, you know, we have been facing the challenge of a liquidity overhang for some time, and we are managing that. We are keeping the weighted average call rate within the policy corridor, reducing the width of that corridor is something that was part of that toolkit, and while our statement acknowledges that from the current lows, inflation is likely to rise, it is going to be about 4% by Q4. And given the factors that we have pointed out, that inflation excluding food and fuel has fallen significantly over the past 3 months, once we exclude the impact of the HRA, which is one source of uncertainty, HRA from the central government side has now been taken care of, and including that in the projection still brings us close to 4%. And we had said that this was a statistical exercise, and therefore it's right for us to net that out. I think what we have done is taken a calibrated policy decision based on the outturns and our projections going forward, and we felt that a 25 basis point cut while keeping the stance neutral was something that we should be doing at this juncture.
Was